Thank you very much. Further debate, the member for Stormont, Dundas, South Glengarry.
Thank you, Speaker. And as PC critic for Consumer and Government Services, I'm pleased to offer my remarks today on Bill 156, Alternative Financing Services Act. I find it a little bit scary when I hear a member of the other side actually blaming our low dollar on the Harper government tying the price of oil to the dollar. I mean, how ludicrous is that? I mean, we have some problems in this province, like high energy, and it's affecting people's ability to pay bills. And before we begin debating this meeting, I'd like to take a moment and give the House an appreciation of why the services discussed in this bill, such as payday lending, check cashing, and lease to own, are defined as alternative. Conventional finance products are those you and I and most Ontarians are very familiar with their day-to-day lives. So familiar, in fact, we don't notice their influence on our lives, or we simply take them for granted. While on the outside they may look simple, they are a result of a series of complex economic and social transactions that happen beyond our field of vision. So let's begin with banking. Banks have been with us for over a millennium. The oldest bank in continuous existence in the world today predates the discovery of the continent this House stands on. The role has evolved dramatically since then, as have consumers of bank services. The greatest factor in the growth of banks and the array of service that they offer, of course, has been the explosion in the middle class in the last 3 centuries, who now have enough money to begin thinking about personal finance rather than making ways to payday. Let me give you just an example of how priorities have changed. Ancient banks in Europe used to issue letters of credit to the consumers who were traveling to different cities with a branch of the same bank, or a friendly local bank that would pay out according to the letter's terms. There was a clear and terrifying motive to this. The possibility of being robbed en route was very high. The less faceless and untraceable cash one carried with them, the less risk there was for loss of personal property. Today we have debit cards. Not because we are concerned about robberies, but because we like the convenience of withdrawing money when we need it and making small purchases without requiring cash. It is easy to take this convenience for granted if we don't see the cost and the complexity of the system. In order to provide us with the convenience of using our plastic cards rather than cash, retailers have to forego a portion of the revenue in order to pay the provider of the point of sale, or the POS for short. This is also the reason why we often see purchase minimums for a card used in stores. Too small a purchase would mean an unsustainable amount eaten out of the issuer's fees to the retailer. When we participate in the conventional financial system fully, we run most of our financial transactions through a bank, including depositing our checks. Here's where the bank policies can become frustrating for some. Some banks will apply a 7 to 10 day business day hold on deposited checks in order to have the funds clear before releasing money to our account. The bank's motivation is clear: minimize the risk of a check bouncing and not having any recourse against the depositing customer. This is one of the many ways banks shield itself from risk in order to provide us with lower fees and different financial products at advantageous rates such as loans and lines of credit. Conventional loans and credit cards also work on the principle of minimizing risk. These debt instruments are designed to provide the issuing institution with a steady stream of revenue at a minimum cost and risk. For example, a no-fee cashback credit card from a major bank is a great option for the consumer as it involves no annual cost, and as long as we pay off the balance each month with no interest. As folk wisdom tells us, there's no such thing as a free lunch. No-fee products are there because issuers want to use them. When we do, a portion of our purchases are handed over to the issuer by the retailer as fees. The more we spend on our zero-fee card with cashback bonuses, the more the issuer earns. Whichever credit product we choose, The issuers will want to ensure we don't run out away with the money. While a functioning crystal ball may come in handy, the next best option is a consumer's credit report. This is a detailed document highlighting the consumer's history with many companies, the number of credit contacts the consumer has, how many of these contacts have been paid, and whether there have been any late payments or any other negative events, and whether the consumer is, overall, a good person who will pay back what he owes. While we are on this subject, Speaker, allow me to diverse into somewhat of a public service announcement for the benefit of all Ontario consumers regarding credit. We get bombarded on almost a daily basis with offers to repair our credit, or to get our credit card report, or to enroll in one of the thousands of credit monitoring programs that, for a fee, will keep an eye on your private information stored with Canada's credit reporting agencies. All of the information that feeds into your credit report, however, is accessible for free to every consumer once every 6 months. By filling out a form and attaching a photocopy of an identity document, a consumer can request a copy of the credit file. In the stack of papers they receive, they will be able to see which accounts are associated in their name, who inquired about the creditworthiness, and whether those accounts have been paid on time. This information must be verified. Seeing accounts you don't recognize or inquiries from companies you never submitted a credit check to could point towards attempts on stealing your identity and open credit accounts in your name. Just a few weeks ago, I got a call from Visa, and they had noticed that just a few minutes before, actually, somebody in the United States had asked about, or had used my Visa card, and it quickly refunded the money to the same account. So I got a call asking me if I made the call, and if I was in South Carolina, I think it came from. But the bank picked up on it right away, and it reminded me last December I was at a conference of the Eastern states and provinces, and I went in. One of the sessions was on credit and the verification, and what they were using was your cell phone to identify where you were and where the purchase was made, and the computer instantly tied these together, and would a red flag would go up, and even to the point where they would deny the transaction if they didn't meet. So instantaneous verification. But it just shows where they're going. And at the time, even though the amount had been taken out and put back right away, they saw that as a test of the system to see by the person that, or a potential test by the person that was using this card, to see if anybody noticed. So it just tells you where it's gone today, and some of the how fast the banks have actually checked what's going on. These errors are fairly straightforward to correct, okay? But it's left to fester, they can wreak havoc on one's credit score and shut you out of a mortgage, a car loan, or other financial products. If there is one takeaway from these preceding speakers, it is that every Ontarian should take control of the credit file by requesting a free copy every 6 months from their major credit reporting companies. Our credit file describes us just as our vital statistics do. It forms a part of who we are in the outside world, whether we choose to show it or not. When it comes to borrowing money, this history can be laid bare to whoever is looking at the computer screen at the loans desk. So why do we go to such troubles then? In exchange for our cooperation, time, and good character, the financial institution can now issue a certain amount of debt that is confident. It will get back at a reasonable rate of interest. Banks minimize their stake in the debt game by weeding out those applicants who they consider either too high a risk or whose record is insufficient to warrant a loan. The old adage goes that to get a loan, you have to prove that you don't need one. In the conventional financial sphere, it appears institutions strive their utmost to reach the ideal zero-risk customer base. As I have 1 hour, I beg your indulgence, Speaker, to share a joke on debt. A rich businessman asks a bank for a $5,000 loan as he is leaving on a 2-week vacation. When asked for collateral, he offers his brand-new luxury car. The bank accepts eagerly and issues a loan at 8%. and brings the car into secure storage. 2 weeks later, the man returns and repays the loan with $15 of interest. When quizzed about why a millionaire would need a $5,000 loan, the man says, where else could I park a luxury car for $15 for 2 weeks? They expect that it would be there when I return. The whole induction should highlight just one key issue. Conventional financial tools are available to us and to many Ontarians. However, many fall through the cracks. A small but relevant percentage of Canadians, when interviewed in 2006 by the Financial Consumers Agency of Canada, stated they had difficulty opening a bank account or a credit union. We take bank accounts and their convenience for granted. However, without an account, life becomes more and a lot less convenient for Ontarians who are least afforded. The challenges that immediately spring to mind include a forced reliance on cash, including carrying large amounts of cash on your person and storing cash at home. This increases the risk of being a victim of crime. While the middle class is concerned about a less violent but still damaging the crime of card cloning, Ontarians without a bank account have to be consistently worried about theft, robbery, and burglary. An inability to receive payroll deposits from one employer, the inability to deposit assistance checks and the Government Canada checks, and the latter being by force of free of charge to deposit. Added challenges to proving one's address. This can then snowball into difficulties renewing Ontario and federal government documents. While this House may, from my previous remarks, have developed an understanding of working poor Ontarians and social assistance recipients' challenges when faced with assessing a credit product, there is another category that faces the catch-22 situation in regards to credit. New immigrants are at a distinct disadvantage when arriving in Canada. Despite being adults, usually packing plenty of education and experience, their credit file in Canada is blank. As such, they are unable to access the same credit product and rates that Canadians of their age would. Following years of building their credit through student loans, store cards, and depending on your age, even a mortgage, when financial institutions see a blank credit file or a social assistance number beginning with a 9, denoting temporary status such as a work permit or study permit, their range of offering for the customer goes down to almost nothing. One of these very few credit products or new arrivals to Canada can gain access is a secured credit card. These cards are issued under the condition that the borrower deposits into a locked account an amount equal or sometimes greater than the demanded credit limit. Members will appreciate that very often family beginning their life in Canada and counting their pennies from payday to payday doesn't have $500 or $1,000 sitting around in order to make that deposit. The vicious circle then begins. Without the ability to build a credit file, the family is unable to build their access to financial products, such as mortgages, car loans, and lines of credits. When they do eventually build up their income in order to afford the deposit, their credit file's age will be lagged behind everyone else's by a significant amount, placing them at a disadvantage. When they eventually apply for a mortgage, the bank is likely to offer them a higher rate due to the combination of credit factors and a credit report. Whether we extend the credit or not, there are situations where individuals or families need cash and they can't afford just to shrug off and tell themselves, well, tough luck. The world, most of the time, doesn't work this way. Conventional finance may have failed these people for a variety of reasons. Risk minimizing policy is certainly one. Monthly fees that a client decided were not worth paying could be another. A third is access. The most acute problem with financial service access is, naturally felt, the most remote communities of the North. Banks do not have the incentive to serve such clients because the population density in the bank's catchment area won't justify the expense. Having to travel 4 hours to your bank is as good as not having a bank at all. Yet I would like to relay stories in my own riding in Stormont, Dundas, and South Glengarry. Local branches seem to be following the fate of many gas stations and closing down, driving up the costs. Online banking competition from urban centres close by. Just like an example, Scotiabank announced the closure of local branches in Maxville, St. Isidore, and Avonmore. Residents of my riding who bank there are expected to move their accounts to a new bank location. And other banks that closed, Lancaster, Williamstown, Martintown, many banks in rural Ontario, small towns, not really that remote, but the cost of doing business with the banks is driving these banks into closing branches. There was a passionate campaign to save the local branches, some of which have been in the community for more than a century. This, however, highlights that even Ontarians in rural access in the south can experience a dearth of access to banks and other financial services. If the banks go and take their ATMs with them, local residents have no choice but to use one of the few ones available in town, often from a competing bank or a private provider. Using these ATMs results in higher fees for the consumer. The same challenge of access brings people to seek cash loans at almost any cost. When they need funds and conventional finances aren't available, with my previous remarks, the perverse cycle of higher need, higher fee continues to apply. Payday lending is a risky business involving a much higher risk for the lender than a conventional finance. So as long as you have an ID and a pay stub, you can borrow money until your next payday. There are no credit checks and there isn't much paperwork, and the payday lending provider doesn't shield their operation from credit risks such as banks and other institutions do. The result, 10% of the payday loans must be written off. They go up in smoke and become bad debt, the kind of debt that poisons any balance sheet. Payday loans are designed for individuals who have a steady stream of income and who experience either an unexpected expense or an unexpected temporary drop in income. This can include new immigrants working several jobs, single mothers, self-employed professionals in need of funds to tide them over to the next client payout. You name it, these Ontarians aren't poor or exploited or financially illiterate. They just don't have conventional finance to turn to. Sometimes the unexpected drop in income can become permanent, or unexpected medical expense can turn into even more needed spending. In those cases, it is very likely the loan will go sour and the company won't be able to recover the money. Here, however, lies the greatest difference between conventional credit and payday lending. Conventional interest is designed to accrue and compound. The longer you carry the debt, the more times the interest clock ticks, resulting in an overall higher charge. In payday lending, the loan fee is paid once, and it neither accrues nor is compounded. The consumer can't be charged for borrowing the fee again. Although a consistent late payer is likely to see access to payday loans cut off entirely, it becomes a black and white scenario. You either can borrow or you can't altogether. Late payers in conventional finance are instead punished by higher interest rates and the denial of higher premium credit products such as credit cards with the greater perks and the advanced bank accounts. This becomes a situation where one shifts between various rates of interest. Advocates against payday lending build their argument on the fact that the maximum $21 fee for borrowing $100 combines to form a very high annualized rate. Their argument would hold some water if the fee were designed to be accruable, i.e. if it was charged into the borrower's account at regular intervals, and compounded, i.e. it's calculated on total remaining principal capital plus the unpaid fees. This comparison between credit card interest and payday lending is therefore a fallacy. It is a comparison of apples to oranges. These two products can't be compared. Firstly, because credit cards belong in the secured, filtered, shielded, credit-checked world of conventional finance, where high-risk potential borrowers have already been weeded out. Secondly, the loan fee can't be recharged on the same loan at the next 2-week interval. What you pay to get the loan is what you will be out of pocket for when you repay it, not a cent more nor a cent less. Speaker, consumers aren't foolish. Most credit cards offer grace periods ranging from 14 days to a month on purchases. Cash advances are subject to fees and interest without a grace period. However, one can expect to get away with a $5 flat cash advance fee or 75% total interest on the cash for a 2-week period, or 0.75. Let's work with the real numbers then. A client walks into a payday loaner with asked to borrow $800. He is given $800 and pays a $168 maximum fee allowed in Ontario for a payday loan. If the same client had a bad credit card, he would take out the $800 and be charged cash advance fee immediately. 2 weeks later, he would accrue $6 in interest for a total of $11. Speaker, with these numbers in hand, if a consumer could be obtained a credit card with a high enough limit to satisfy the cash needs, wouldn't he or she have one already? If consumers don't have a conventional finance product that suits their needs and are interested in resorting to payday lending, isn't that more a reflection of the Ministry of Consumer Services and the Ministry of Finance? If it is indeed the case, the government should be looking at themselves and taking a moment to ponder whether, rather than spending millions of dollars on promoting themselves and their job-killing policies, they should instead have to spend their money on financial literacy and awareness, saving Ontarians hundreds of dollars in fees. We have therefore established that payday lending is not an interest product, but a fee-based product. You pay once and you don't pay on the same loan again. We have also established from conversations with the industry that 10% of all payday loans go sour and can't be repaid. If a bank had such a loan default rate on their books, they would be ordered out of business. Banks make a revenue by charging us the interest rates that we are used to, close to $5 in each $100 per annum. This covers their expenses with the Bank of Canada, the necessary risk adjustments, their operating expenses, and leaves a margin for profit. A 10% default rate would drive a bank or credit card issuer into the ground. Right off the bat, therefore, we see that a fee-based product that must be charged in full at the moment of taking a loan should cost about $10 for every $100. This amount is assigned to take into account the inherent risk of the loan only. To that $10 we must add to the incredibly high licensing costs, hundreds of dollars per location in Ontario, rent and utilities for location, including growing hydro rates, staff wages, because people don't work for free, bank fees for processing borrowers' checks, and the corresponding bounce penalties, as well as the lender's own interest charges for the capital they need to borrow from a bank at the market rates to lend to customers. The exception to the last point would be when a payday lending company sits on its own stash of cash waiting for customers to come in. A very poor strategic choice, considering the same cash could be earning you more when properly invested in conventional finance products such as dividend stocks. Back in 2004, Ernst & Young conducted a survey on the then budding payday industry in Canada and found that the weighted average of extending each $100 of credit was $15.69. That was broken into $10.58 of operating costs, 52 cents cost of loan capital, 59 and 57 cents of cost of supplementary capital, and $4.02 for bad debt costs. It appears in 12 years we may have taken down the operating costs, but the bad debt costs may have risen. If you recall my previous remarks, I mentioned that commercial bank had the bad debt performance of the payday lending industry would face either a shareholder revolt or run on the bank. So let's consider in the vein of comparing apples to apples. And we see the data from the same Ernst & Young report regarding banks' provision for credit losses. This measure is a direct quantification of how much all lenders pay extra for loans because their loans go sour. In the same year of 2004, major commercial banks' provisions for credit losses ranged anywhere from 15% to 0.82% for average loans, a fraction of the payday lenders' reported bad debt provision portion of their rating of loans. So my advice to the government and to advocates, therefore, is not to make attempts to compare payday lending costs and services to conventional finance products, because in reality, most consumers who could opt out for conventional finance products would take them. If they came to a regulated payday lender, there's a reason. Sometimes it's access, but sometimes it's just a matter of time. For instance, a consumer with a line of credit can access substantial amounts of money fast. With a loan, the consumer needs to wait several business days for the bank to process the application. In both cases, the consumer will often need to offer the bank collateral, something that many Ontarians just don't have, or are willing or unwilling for a variety of reasons. Regulated payday lending fills the cracks in the federally regulated banking and credit system through which all Ontarians can fall. Despite this, the two industries are very different on very different sides of the same coin. On one side, you have conventional finance, where consumers invest time to build their creditworthiness and net worth in order to access financial products at better rates, and is prepared to wait for all credit checks and internal bank review to complete. In the payday lending industry, the dynamic is much more rapid. A loan can be extended in minutes, as long as the customer's documents check out. If time is money, and the contrast between the conventional and alternative financial product costs expresses that concept clearly. According to the Financial Capability Survey in 2006, a demographic most likely to have used payday lending and check cashing services were Aboriginal peoples in northern communities. Conventional banks do not extend their physical presence in small northern communities, and many on reserve. First Nation members find it nigh on to impossible to secure the kind of collateral-backed financial product due to the community structure. We come then to Bill 156. It follows in the footsteps of the Payday Lending Act, which created a framework for payday lending to be legal in Ontario after the Government of Canada created an exemption for several federal provisions in matters of lending and interest. Payday lending is widespread in Ontario. It is regulated, and consumers of payday loans enjoy a wide range of protections, including current requirements for lenders to post the cost of their services very clearly and make consumers aware of their rights. Bill 156 takes the current regulatory framework and expands it immensely in favor of the government. So let's begin by examining Schedule 3 in detail. In its first section, the government's first salvo of this charge on payday lending issue, if you wish, Bill 156 immediately takes business matters into legislative hands. Under this provision, a payday lender who extends a third loan within a 2-month period to the same customer will offer that customer a 2-month repayment program. No questions asked. So let's analyze, just for a second, one customer, 3 payday loans, 2 months. Something is definitely wrong here. Even if an untrained analyst could see that a person that resorts to a payday loan 3 times in 2 months is selling one of every 2 paychecks they receive. These customers need credit counseling and money management skills, not different payment terms. The industry is well aware of this. The Canadian Payday Lending Association is always adamant that payday loans are supposed to be an occasional source of emergency funding to cover an unexpected expense or a sudden drop in income. I can sympathize with some of their customers who opened up a hydro bill and were threatened by the disconnection after surviving the shock. A payday loan is not supposed to be a regular source of funding. It is an expensive way to receive immediate cash, and customers are well advised of this. 3 payday loans in a 2-month period means your situation isn't involving a sudden expense or income drop. Those factors are a consistent gnawing stressor to your finances, and you will definitely need to look at your budget. By introducing a mandatory extended payment period, the government is doing 2 things wrong. Firstly, they are allowing a distressed borrower to clear unresolved financial challenges to express their payment period without providing any assurances that this particular course of action will make their financial situation any better. On the contrary, they are increasing the chances of the loan never being repaid, as the borrower's financial system is likely to demand another payday loan from another lender while the other one is being repaid. It is a recipe for personal financial disaster. Secondly, the customer is equating the government is equating payday loans with a problem. The resort to payday lending is a symptom of an underlying financial condition. Whether it is caused by one of the factors I listed in the opening part of my remarks or others, it is the borrower's budgeting that needs to be tackled, not the provision of the payday loan. Most payday lenders will meet customers they know and trust halfway already by offering extended payment periods, whether the customer indicates his or her economic situation is difficult. In those cases, the lender is happy to extend the payment deadline because they are confident the customer can commit or meet their obligations. What the government is doing, however, is creating a mandatory offer of a longer repayment period without any guarantees that the borrower can actually meet his or her repayments. The end result could well be an increase in loan defaults and therefore a higher cost for everyone, including conscientious borrowers. Eventually, lenders may choose to simply not extend a third loan. This is arguably the intent of the legislation. Regulate third loans out of existence. This section is an effective way to achieve this. However, it doesn't solve the underlying problem of a client's financial challenges that drove him or her to a payday lending company in the first place. This person will still be in need of money whether the lender allows them to take out a loan or not. Where will the client turn to? They could turn to a competitor. Since there isn't any national database on the payday borrowers, the cycle begins anew. People with such frequent payday lending needs don't need restrictions on payday lending. They need intense credit counseling and access to good money management skills. Cutting them off from precarious lifeline of payday loans won't do them any good if they still loose in the sea of financial problems. The next provision of the bill, and I guess just to explain that, when you walk down Yonge Street, 8 o'clock at any time of the night, there's no less than a dozen of these payday loan offices open. If you don't go to one, you simply cross over to the other one. So we're not really doing very much by shutting the person out of getting the third loan. There's a problem there and it needs to be fixed. The next provision of the bill is also designed to cut people from access to payday loans by prescribing a minimum waiting period between loans. My previous objections to limiting the supply of service apply here as well. How long can a customer be barred from payday lending for is irrelevant to the purpose of this discussion? A person in financial distress who has no access to conventional finance is more likely to suddenly have the means to sustain themselves from a paycheck to paycheck without access to payday loans than with it. So let me reiterate that a payday loan is supposed to be a way for Ontarians with no immediate access to a conventional finance product and to come up with cash to cover a sudden expense or drop in income. And as I said before, 3 payday loans in a 2-month period are symptomatic of a permanent financial distress. Payday loans aren't the problem with the case here. They are simply an expensive lifeline. Diligent and law-abiding lenders already refer to such clients as refer these clients to credit counseling services in order to help them with their financial house, to keep their financial house in order. However, much more can be done to ensure Ontarians don't fall into a situation where payday lending becomes the only financial product that can suit their needs. Next, the government delves even deeper into micromanagement of the industry. Section 21 of the bill creates a power for the government to govern the content, size, and location of advertising and signage for the payday lending business. This bears an uncanny resemblance to a much maligned signage regulations in the province of Quebec, a characteristic of the province we have so far been proudly avoiding. As anyone who has even run a retail business will know, all locations are different. Depending on the property type, one could have any number of options or restrictions for placing signage or advertisements on their premises on the outside of their buildings. What government is going to create a one-size-fits-all approach that will probably force many locations to either close or invest heavily in renovations in order to comply with this new regulation, while at the same time doing nothing to help the payday lending clients access to conventional finance? The last provision written in the Payday Loan Act by this new bill allows the government to order businesses to stop providing financial services outside of payday loans if it so decides. Speaker, it would not make sense to separate key cutting from automotive shops or shoe repairs, but it would make just as much little sense to impose a separation between payday lending and other alternative financial products offered by payday lending at locations such as check cashing or prepaid credit cards. It is demonstrably the wrong thing to do. Allow me to go back to the Ernst & Young report, which did break down operating and other costs and the impact on business in the industry. Accordingly to whether the business is provided just one product, payday loans, or a wider range of services. All costs are considerably higher for single product businesses. A reason is crystal clear to anyone who has looked at the industry. The payday loan is a risky proposition for lenders, while other products such as fee-based prepaid credit cards, tax filing, and check cashing are much safer. Just as in many competitive industries, the profit comes from the higher added value products, rather than the principal offering. We can compare the payday lending locations to a gas station. While there is a steady but small profit from the gas, or a payday loan, the largest profit comes from the convenience store. And I do not wish to question the government's good intentions, as I am confident they wish to ensure consumers entering a payday lending location aren't overwhelmed by the product offering and the potential pressuring to accept a product they don't really require. This is, however, the wrong way to go about achieving their aim. The minister is setting out regulatory framework down the path taken by Quebec, which resulted in payday lenders quitting the province altogether. When payday lending was legalized in Canada, Quebec chose to cap the annual interest rate at 35%, which would translate into about a 1.16% biweekly interest. If payday loans were an interest-based product, and they aren't, a payday loan would cost no more than $1.16 per $100 borrowed. As you can see, Speaker, this low fee wouldn't be enough to cover the operating cost of a payday loan operator or the cost of capital. Bad debts would then deliver the final blow to the business. A practice of overpaying lending was effectively priced out of the province of Quebec, leaving only other services such as check cashing. And don't think for a moment that the financial stressors that contribute to the people seeking payday loans vanished altogether with the everyday loan providers. Just as taking out a decongestant won't cure your cold, driving payday lending out of business doesn't resolve the question of residents being in worse financial shape than they'd like to be and without access to conventional financial products to suit their needs. In the absence of alternative financing service providers, people could then be driven to the unregulated and underground markets, which carry infinitely more risk and both higher social and economic costs. A simple Google search can reveal hundreds of companies operating outside Ontario and potentially federal regulation soliciting Ontarians for financial information in exchange for cash. There are no guarantees regarding the trustworthiness of these companies. There's no way of knowing whether their privacy policies comply with Canadian or Ontario laws, and there is certainly no guarantee they won't just take your valuable data and sell it to the highest business. Most of us would back away from such a deal immediately, but we put ourselves in the shoes of the self-employed person whose contract just fell through, and whose next contract won't generate enough income for a while. We would find ourselves tempted to go to great lengths to put food on the table. In an ideal world, Speaker, payday lenders wouldn't be needed. We don't live in one, and we won't see one in the foreseeable future. Payday lending is a safety valve that stands between people's legitimate need for cash and money management advice, and the unregulated, unscrupulous, and unreliable underground debt market. As far as Payday Loans Act is concerned, this bill is bad legislation. It refuses to tackle what causes Ontarians financial distress while at the same time micromanaging an already tightly regulated, overseen, and taxed industry. Shortly after my first appointment to the role of critic for consumer services, the Auditor General released the 2011 annual budget, which contained a follow-up to the previous value for money audit of the Ministry of Consumer Services. As in the previous audit, the auditor found that most Ontarians wouldn't consider the ministry a top source of information about their own rights or an avenue to resolve a complaint against the company. In this year's estimates, tabled on March 23rd, we see a net reduction of $1.1 million in the funding level for Consumer Protection Program at the Ministry of Government and Consumer Services. This pales in comparison to the drop since fiscal year 2014, the last for which public accounts was available. In 2014, the Minister's Consumer Services Division was funded with $19.3 million. This year, the program will receive just $15.6 million. My consistency office fields several complaints a month from constituents who are unaware of the existence of the ministry or its consumer protection program and the help they can provide through their toll-free line. My advice to the minister is to get rid of Schedule 3 of this bill altogether and focus instead on giving Ontarians better access to conventional financial services, credit counseling, and financial literacy. Some of these initiatives can be carried out in-house. I suggest the minister begin by reducing his reliability on the ministry's website and engage Ontarians more broadly in the community in order to educate them about their rights as consumers and the money management tools available to them, and which would prevent the stress of unexpected expenses that can be covered out of savings or insurance. The government could also give Ontarians more chances to retain a larger portion of their income and save it and to use it for investment, as their policies over the past decade have eroded Ontarians' disposable incomes through job-killing policies, payroll deductions, and sky-high hydro rates. The government could look themselves in the mirror and reverse their actions that are leading more and more Ontarians closer to the limit of not being able to afford to pay their bills. While banks are federally regulated and credit unions may choose that option under new federal rules, the Ontario government can still facilitate more Ontarians access to conventional finance by promoting bank account ownership and direct deposit. One initiative I would suggest the government take into consideration would be the reduction of the impact of bank account and transaction fees for the neediest Ontarians in the same spirit as Ontario Works Well today cover vital statistics certificate fees for its clients. According to the 2006 General Survey Consumers Financial Awareness, 56% of Canadians reported the bank fees being $10 a month or lower. Conversely, 44% of Canadians spend in excess of $10 a month for a bank account. These fees may appear low to Ontarians with a stable income, close to or above the median. However, they can be a significant impact on a budget of a low-income family or a social assistance recipient. Mitigating this expense could assist in reducing other expenses for the government and its agencies, such as the expense of producing, mailing, and tracking checks. The government may be trying to shield consumers from bad players in the payday loan and lending industry. However, the law of unintended consequences, they may be depriving Ontarians of access to lawful alternative services without giving them a way to transition to conventional finance. Let me now turn to two significant amendments this bill makes to the Consumer Protection Act. The first change concerns agreements to cash government checks. Payday lending outlets will often offer their service for a fixed fee plus a percentage of the cash of the check amount. In exchange, the customer receives the full amount of the check without delays or hold. And cashing service naturally assumes the risk of the check being fake, an increasingly common problem as printing and editing technologies evolve. There are already plenty of options for cost-free cashing. First and foremost, cashing a Government of Canada cheque is absolutely free of charge in any Canadian financial institution, regardless of whether the client has an account at the institution or not. In the 2006 Financial Consumer Agency of Canada survey I mentioned, however, only 22% of the respondents were aware of this. References from 2015 highlighted that the Royal Bank of Canada branches in Toronto would cash an Ontario Works cheque free of charge. This is the kind of partnership the Government of Ontario should be promoting with banks and credit unions across the province in order to give recipients of government checks more options to keep all their money rather than see it evaporate in fees.
Very true.
Instead, Bill 156 simply gives the government carte blanche for regulating the total fee charged for cashing a government check and mandating that the information must be displayed where such a service is offered. Regulated payday lending locations where check cashing is offered already provides consumers with ample information regarding the fee they will be charged to cash a check. The net result of the disclosure provision will likely be minimal. The current fee structure for cashing checks of all kinds, including government ones, tends to fall within the 3 and 3 rule. For instance, a fixed $3 service charge and an additional $3 for the 3% of the check amount. This is undoubtedly higher than the fee for depositing checks into an account at any financial institution. Yet some consumers may choose this route if they require the funds immediately and can't afford to wait for the deposit to be held. As before, Speaker, time is money. And if the consumer has an account at a financial institution where checks are normally held before being cleared into the account, the consumer may opt for a faster but more expensive route in order to access funds on the same date. If this legislation passes into the books, I advise the Minister to be extremely careful in drafting regulations under the fee cap provision. Whichever amount the Ministry chooses as the fee cap, it must be significantly high enough to cover the inevitable losses from falsified checks. If it doesn't, we will experience what Quebec experienced with payday loans. Check cashing services will vanish without there being any conventional finance alternative available. And this won't solve the problem. Checks will still be issued to individuals unable to deposit them in financial institutions. But where will they turn to? I will also point out that this bill doesn't take into account that many users of both payday lending and check cashing services are self-employed and therefore are likely to come into the store with a non-government check for cashing. Their transaction will not fall under the provisions of this bill, potentially creating a two-tiered cashing framework. So let me turn now to the leases, where general credit agreements covered in two distinct parts of the Consumer Protection Act. Bill 156 contains a short amendment to Section 87 of the Act to give the Ministry the power to terminate, by regulation, more types of leases to which the Consumer Protection Act Part 8 will apply. This is a powerful amendment, but we'll have to wait for the regulations to be issued under this new authority in order to gauge the government's aim. The Ministry and advocates report ostensibly that the intent of the bill is to provide a grace period for consumers who enter into a lease-to-own contract. The wording is nowhere to be found in Bill 156. There is, however, a general regulation-making provision written into the existing Consumer Protection Act for Part 8 leases that allows the Minister to issue regulations governing those leases. Section 87's definition of the leases that fall under the jurisdiction, including 4 particular types of leases: fixed-term leases for 4 months or more, indefinite lease term leases, auto-renewed leases until such time as one of the parties terminates them, and leases where the consumer is expected to pay some additional fee at the end. Most rent-to-own contracts would fall within these parameters, and I would encourage the Minister to highlight why the inclusion of the carte blanche provision is necessary. We have heard stories about rent-to-own companies charging consumers the equivalent of almost 6% annual interest rates, resulting in significant overpayments by their consumers who can least afford them. Missed payments can trigger severe penalties or even the forfeiture of goods, as well as the funds already invested in them. Members on all sides of this House agree that an annual interest rate with recurring charges and compounding greater than 60% is unsurly, plain and simple. Approaching such an interest rate of any kind in long-term release may be legal, but is nevertheless incomprehensible and morally objectionable. We support the government's initiative to make rent-to-own contracts more transparent, including giving consumers the true cost of the contract and a grace period for missed payments. We would like, however, to see these regulation-making powers hard-coded into the legislation rather than simply falling under the general regulation-making power existing in Section 128. Allow me to explore the tangible issue here, Speaker. Rent-to-own contracts would look much less appealing to consumers if they saw that the true lifetime cost of the contract was. This is one facet of the all-in pricing issue. The Ministry will be well aware that other industries where all-in pricing is being demanded. Consumers in Ontario who wish to buy a vehicle are currently faced with two price sets, one provided by the manufacturer's advertising and one provided by the dealer. The two are different because the manufacturer is not obliged to include the dealer's costs or any other costs associated with the vehicle purchased in the advertised vehicle price. Consumers, therefore, find themselves at a loss at the dealership, where the all-in cost of the vehicle becomes clear. Speaker, this is unfair to the dealer, where his honesty is called into question, and to the consumer. If price transparency is a good for the goose, it must also be good for the gander. The new sections of the Consumer Protection Act also deals with general credit agreements. Bill 156 established a particularly curious precedent where a lender that enters into a credit agreement regulated by Part 7 of the Consumer Protection Act has to disclose to the consumer an evaluation of the risk factors that led to the decision to issue or not issue credit. An example, Speaker, we don't ask this of our banks, credit card companies, or insurers. Their risk evaluation methods are proprietary information, and only consumers can see the outcome. These algorithms are one of the trade secrets that lenders compete on, screening for the most secure borrowers. In a recent judgment, the Supreme Court highlighted that provincial disclosure regulations might not impinge on federal regulated agencies and the federal government's ability to regulate them. In that particular case, the Quebec lender was found guilty of not making certain Quebec-specific consumer disclosures. If and when the government chooses to amend the Consumer Protection Act, Part 7, to increase the range of credit agreements Part 7 extends to, we should see a significant challenge coming our way. The credit issuers would be required to disclose their evaluations of consumers' credit risk. And I wish to share my concern that this would restrict Ontarians' access to credit across the board. I will now turn my attention to the last portion of the bill, the amendments to the Collections Act. Collections is a thankless job, whereas a company sends bad debts to a collector for pennies on the dollar, and the collector then expends his resources trying to recover those debts to the consumer. In short, the direct owner of the contract has thrown in the towel on the consumer and sold off the liability to cut his losses. Collections agencies are consistently the most complained about business according to the Ministry's own statistics, and there are very good reasons for this. A collector's duty is to be persistent and annoying until such time as the debt is repaid. When exercised correctly, the collection profession is a source of consumer annoyance and stress. When the collectors overstep their bounds, however, it can be a case of criminal harassment, uttering threats, and more. The current Collections Act regulates individual collectors and their employees very tightly. There are very precise, legislatively coded restrictions on what a collector can do and how often they can call, when they call, etc. Consumers at the receiving end of the collection calls are understandably subject to incredible amounts of stress. They often don't have the funds available to them and could potentially face the stigma of their debt situation becoming known on the street. In this optic, I find it surprising that the government is removing the requirement for individual collectors to be registered with the Ministry of Government and Consumer Services. Today, collectors must be registered, and any changes to their employment status with an agency must be notified to the registrar. No one can collect money in Ontario without that registration, and the registrar may deny either an individual or an agency registration based on past conduct. If this bill makes it into law, the individual requirement will be gone. So here is a worked example. Under the current system, if John collects for We Collect, both John and We Collect must be registered and in good standing with the ministry. When John leaves We Collect, his registration remains valid, but he may continue collecting and be subject to the ministry's disciplinary procedure if he steps out of line. Under the new law, We Collect notifies the ministry of John's hiring and firing. However, John can still go and collect on behalf of agencies that are not headquartered in Ontario and may turn a blind eye to John's antics. The only individual collectors who will remain registered under this new act will be those single-person operations to purchase debts and collect them. For all others, it will be a free-for-all. And as I've highlighted before, Speaker, the Ministry's record of making Ontarians aware of their rights and their ability to call the Consumer Protection Line is far from optimal. Considering the heat collectors place on consumers, I wish to convey to the Minister our strongest objection to removing the requirement for individual collectors to be registered with the Ministry. There will always be bad players in any industry. Payday lenders had their black sheep in the cash store who sought to circumvent provincial payday lending regulation by marketing their product as a line of credit, with a mandatory repayment period for a significant portion of the borrowed capital. That sorry tale is finally over as the cash store was ruled against it in the Ontario court and is filed for bankruptcy due to the ongoing financial problems. Collection agencies have their own demons as well. Consumers have the right to be protected from bad players in the industry. Although we welcome the government's initiative to impose harsher penalties on collection agencies that breach the law, I strongly urge the Minister to take out all provisions that would allow any individual to carry out the business of collecting debts without first being registered in Ontario. We don't need this complication. The Minister will also have to step up his efforts to improve its inspection and enforcement regime. In 2011 annual report, the Auditor General highlighted that a significant amount of work remains to be done in order to address the consumer complaints and promote compliance in the area of business that the Ministry regulates. Cuts to the expenditure in the consumer services programs don't point to an improvement in this front. Overall, Speaker, this bill contains one good provision on penalties for collection agencies, one so-called provision regarding rent-to-own contracts, and the remainder could be defined as either bad or redundant legislation designed more for publicity than the actual improvement of Ontario's consumer law. We will be filing amendments to trim down this bill and to make the bill address the true concerns of the industry. And Speaker, we have many issues where we see this government micromanaging business, and this is just another case where it's getting in the way, not getting after the real issues that are hitting the consumers in Ontario. We see people coming into my consit office, and they have problems. They're trying to decide, do they try to eat this month or do they pay out the bills? And the one example that was given to us, a person is hit with a surprise hydro bill. And we've had bills, hydro bills brought into our office where there's 3 or 4 or sometimes 10 or more times what the normal rate is, supposedly because an issue with a smart meter. Now the consumer has to decide, does he make that payment or does he take a chance of having the service cut off? And we all know if the service is cut off, there's a huge penalty to get it hooked up again. So yeah, in some ways, maybe the $100 fee seems a lot to somebody that needs money today. But the alternative may be a $1,000 fee to get the hydro reconnected, plus all the problems to go and the delays with no hydro. In my own riding, we had a grocery store owner hit with that situation, can't afford to turn his freezers off or he's out of business. Those are the issues that are hitting many consumers in Ontario. And I think that we're not doing them any help by just getting in the way of some of these businesses that are there. If they are closed, then of course people are into the trench coat borrowing, which we've seen in over time as not being the right answer. Thank you, Speaker.